Can alternative EV startups like Lucid and Rivian make it to the other side in 2024? This is the question on many folks' minds after the companies reported their second quarter earnings reports, which, although met analyst expectations and saw a lot of good news around them, were still significantly off initial expectations from many years ago. As we all know, this has become a really common trend in the electric vehicle segment. 2020 saw a boom of EV startups raising money to challenge Tesla and the status quo. Many failed, some succeeded, and some are still here today to make a name and a dent in the market share of the auto industry. However, the argument has now pivoted from just a cash burn problem to a potential demand issue for these newer startups. Because unlike in years of past, today competition is higher than ever before, and values for trade-ins for EVs and used car EVs are also at all-time lows. This is already a big headache for a big OEM like Tesla, Volkswagen, Ford, or GM, which sell a lot of EVs globally. But it's an even bigger problem for incumbents in the industry, specifically in the United States, like Rivian and Lucid. So what exactly are the odds of these companies succeeding in their ventures, even though so far both of them have done decently well? And well, what better way to start things off, folks, than by first addressing the mayhem we have seen over the past 3 years. As this chart shows you, valuations for the publicly listed companies and EV startups have collapsed since 2021. This truly is a really sad reality of where we are today, which is the fact that people got ripped off in their faces over the past few years, particularly those in retail investing. The Spack Bubble, prompted by the influx of money spent by the government, resulted in record low financing rates and allowed a lot of these companies to trade their shares publicly, allowing insiders and even institutions to dump them on the public markets to the retail public. An experienced investor could have potentially seen this coming from a long time ago. However, for most people in this industry, this was a really harsh reality. It's not that these companies are poorly managed or actual bad businesses. It's just that these companies had too high of a valuation for what they were actually worth at the time. Now, this might not matter to the consumer on the surface who's buying these cars, but it does affect them in the long term. Because the more companies in this industry go out of business, it generally raises the suspicion and the financing costs of new companies, potentially decreasing the longevity and increasing the prices of cars long term. And if your company goes bust, the warranty that you bought your product with is obviously no longer going to be guaranteed, which will obviously result in higher insurance costs and potentially extremely expensive repair bills if you were to get in an accident. And as it turns out, the only real way to avoid this is by investing capital in the private markets, as somebody like Lucid just showed us last week with their brand new $750 million private infusion from the government of Saudi Arabia. There is no cheap capital, and that is exactly what you need right now for these companies to produce vehicles at scale. Rivian, for example, is one of the more well-positioned companies in this industry, having been publicly traded for about 3 years now, with a cash position of almost $9 billion, updated today with the Volkswagen investment just over the past few weeks. What's more is that the company is expected to produce 57,000 units this year, which is well below their actual projection last year, but obviously has to take into account the overall EV market slowdown. And this EV market slowdown, folks, is pretty freaking real. as even something like a Halo product like the Cybertruck has just seen its Foundation Series reservations go bust and now being publicly available to anybody who wants to buy them. Momentum in the EV industry has slowed down because of rising interest rates and an influx of inventory. These companies are producing at rapid scale, but consumers, although still mostly okay with owning an electric car, have slowed their growth down significantly. What this is resulting in is an extremely high barrier to entry for electric vehicles. Not only for a traditional Lucid, Rivian, or Tesla, but actually even conventional OEMs like Toyota who are struggling to compete in the market. This is a really important point that many people fail to understand, which is the idea that although these companies are burning cash, unsurprisingly, that is what it takes to build a moat and build a competitive product in this industry. And although the market has slowed down and consolidated significantly since 2021, when Lucid and Rivian both raised their prices, this significantly improves their market share opportunity going into the end of the decade. Once we get out of this slowdown and interest rates start to come down, along with the yield curve uninverting, people are going to be much more inclined to take heavier, more growth-focused investment opportunities. And as seen by government incentives and regulation, there clearly is already a private sector market for these kinds of businesses. These companies also have a very good technological advantage because of their ground zero start and significant leverage in hiring talent, resulting in significant moats for both Lucid and Rivian with battery energy density, potential software architectures, EV battery management, and even product design itself. And the other big factor that's going to drive these companies out of their current rut is product innovation. As used vehicle prices have come down significantly, there are more options for buyers out there. And they need even more options to keep coming on the market because right now the breadth of the product portfolio is still very low. And with something like the Rivian R2 starting at potentially $45,000 coming out within the next 18 months and Lucid's own Gravity SUV, there is a significant amount of opportunity for these companies to make a dent and continue to grow revenue, even though right now the outlook looks relatively grim. Obviously, there's going to be challenges in this industry, folks, and there is no guarantee that these companies are going to survive. But the reality is, odds are looking much better than they've ever done before. And if they've made it so far and made it through the grime and dust of the interest rate hike cycle, chances are they have an even better chance of making it past this current slowdown. It'll be worth watching how this evolves, but as usual, folks, that is just my take on the situation, so let me know your thoughts down in the comment section below. Take care.